So there is one stock that I want to talk to you guys about today because I've been buying pretty heavy into it. And I think it has huge future potential when you look at how much the stock price has really just been crushed into the ground. It has a dirt cheap valuation, has a mouth-watering dividend, and has a business that I think can easily turn things around long term. And that stock is a biotech known as Bristol Myers Squibb, who from the top has now seen their stock lose over 40% of its entire value, leaving it trading even lower today than it did an entire decade ago. And that's a huge crash. And not that I ever really focus too much on technical analysis, because I am much more of a business fundamentals and stock valuation type of investor, long-term investor. But when you have such an obvious multiple support levels where the stock is almost always rebounding, bouncing off of those lows, well, I just think that it is pretty clear that the stock price could very easily soar from here under the right conditions. In fact, I personally feel that Bristol should be trading about double the price in the future from where it is today. And I'll explain why in just a second. But not only do we have just such obvious levels of technical support here again, but fundamentally, the stock is also deeply undervalued on pretty much every metric that you look at. In fact, their forward PE ratio is not only more than 60% lower than both their own 5-year average and the sector median, but if we look out even further than that into a little bit of the future, their price to earnings to growth ratio, PEG, is more than 90% cheaper than the sector too. And that just screams deep value right here, guys. And you know what else screams deep value to me is the dividend. Because if we look at like just the past decade, for example, we can see that the stock price is never really allowed to trade this low because it ends up sending the dividend yield soaring too high, essentially, which we've almost never seen it get to these levels. In other words, whenever the stock price starts to go down, sending the dividend yield rising, the market always corrects for it because investors start flooding back into the stock trying to get that huge dividend, which sends the stock price soaring because of the demand again, while dragging that dividend yield back down. But because I am a buyer of the stock right now, I'm able to basically lock in that really low stock price, what we call the cost basis, while also locking in that huge dividend yield. Because when the stock starts to rise again and the dividend yield goes back down, I'm still going to be collecting that huge dividend based on today's prices that I'm locking in. And I'm also going to be benefiting from the stock price rising again if it does rebound. Now, speaking of the dividend yield, at today's prices, I'd be locking in at least more than a 5.3% yield as long as the dividend doesn't get cut, which I don't think is going to happen anytime soon either because the payout ratio is extremely low here at only 33%, meaning that they can easily afford to pay it and will likely grow it even larger over time. And that's something that they've not only done for an extremely long time. In fact, I believe that they've paid this dividend for close to 100 years in a row, almost a century now, that they've paid a dividend every single year, but they've also grown that dividend every single year consistently for the past 17 years in a row. And I think most recently, I believe, you can correct me if I'm wrong, but I think the only time they cut it was during the Great Recession, which was a horrible, time. And I'm not even sure if they did cut it or they just kind of paused it. But either way, they went right back to growing it like the very next year after, I think it was like '08. So anyway, point being that this is a company that, as far as I can tell, seems to be extremely committed to paying their dividends. They can easily afford it right now. And really, and the only reason why anybody would be afraid of them cutting it is because of the current business struggles, which I'm going to break down for you why I'm not concerned about that either in a second. Now, obviously, that doesn't mean that there is no risk here or that there is nothing wrong with the business. You wouldn't get a stock like this so incredibly cheap right now if everything was just going perfect for them. Obviously, you're going to have some current struggles in their business. And that is the reason why investors are panicking or worried about it selling down the stock. But let's take a closer look at just how much risk there is here and whether they can turn the business around, which I believe they can, and we'll dive into it. Now, for sure, the biggest issue is that at the moment, Bristol is facing one of the steepest patent protection cliffs within the entire industry, with several key drugs either having already lost patent protection or expected to lose it by 2028, like in the case of their best-selling blood thinner and cancer medications, Eliquis and Opdivo, respectively, which, by the way, make up the number 2 and number 4 spots of the top 10 drugs to lose patent protection over the next 5 years, according to Clinical Research. So that is a very big deal, obviously. And because of this, despite generating record high sales last year, analysts are actually expecting there to be declines in each of the next 3 years, which is obviously alarming to investors. On top of which, profits from earnings per share actually crashed last year, and they even turned negative by a fairly large amount too. And thus, investors are just panicking now, really not sure of what to make of all of this suddenly really bad performance within the company. They don't really know how to deal with that. They're just kind of selling out of the stock, which is a totally reasonable reaction. I'm not gonna, knock them for that. Obviously, things are just not going well at the moment. But here's the thing. This is what I think everyone is kind of really missing here. And I see it happen all the time, especially with, I would say, pharmaceutical stocks, where they ignore some of the deeper details. They ignore the bigger long-term picture. And most importantly, they seem to forget that pharmaceutical stocks are some of the most cyclical that we actually have in the market. Now, cyclical in terms of not the entire sector of it, not the entire industry, pharmaceutical industry, but individually, pharmaceutical stocks can be very cyclical. They can go through waves because they'll go through a moment where certain drugs will take off. They'll generate mind-blowing profits. We know that pharmaceuticals can be some of the most lucrative, products to be out there in the market. So some of those drugs take off. They generate huge profits. The stock prices soar accordingly because investors get all hyped about this, the business and the stock. So that sends demand rising, sends the stock soaring. And then when those drugs inevitably lose patent protection at some point, the growth slows down and investors start to panic and they sell, only for the company, at least the good ones, to later develop new treatments, pull drugs from their pipeline, get those past regulatory hurdles, get those out in the market, or even make large acquisitions to restart that growth engine again. And then the whole entire process basically gets repeated all over again. In other words, in my opinion, large and well-established biotechs like Bristol, Merck, Pfizer, AbbVie, and more are best purchased during these downturns at the lowest prices possible, when you can lock in that low share price and the high dividend for when the company will inevitably rebound. And that's exactly what I expect to happen this time too. And here's why. Now, first off, the giant EPS drop of last year, that was mostly due to one-time charges from a $14 billion acquisition that they made in Karuna Pharmaceuticals, which, when you look beyond that, their EPS is actually expected to recover to a new record high this year, hence why their forward PE is so incredibly low. On top of that, not only does a giant acquisition like this add new products and verticals for the company, but it also improves synergies and margins longer term, which doesn't just include Karuna, but also multiple other large acquisitions that they've made more recently, like in Mirati Therapeutics and Raise Bio, all three of which have experimental therapies in late-stage clinical trials that could become blockbuster drugs, generating over $1 billion in annual revenue each. Second, Bristol is not only adding new indications to some of their legacy drugs like Opdivo, but they've also launched several new drugs from their growth portfolio that will not only help them to really make up the losses from their legacy programs, but these new ones are also going to be much higher margin too. Hence why, despite sales falling, profits are actually going to be soaring again and recovering. For example, last quarter, their growth portfolio actually became just as large as their legacy one, on a whopping 16% revenue growth year over year, for which the CFO said during the earnings call, he said, quote, "We are shifting our portfolio towards more specialty and first-in-class medicines, which carry structurally higher gross margins compared to the legacy products." So in other words, they're becoming more profitable. By the way, Bristol Myers has also launched new cost-cutting initiatives. It's going to end up saving them billions longer term. They're also buying back stock. All of that helps improve your EPS numbers too. And so because of all of this, I just feel that I'm really left here with an established leader in the pharmaceutical space that is currently down because of a short-term transitionary period that admittedly does add some risk, but longer term, it also gives me a tremendous turnaround opportunity for a monster dividend stock that I don't think I would otherwise get. And so for me, I just think that it's worth the risk. Obviously, make your own decisions, do your own research. I'm just sharing with you what I do, my personal opinions, but that's how I feel about Bristol Myers. And so I've been buying the stock. I just wanted to share that with you. Hey, if you enjoyed the video, hit that like button. Let me know what you think about all of this down below. I'd love to hear your thoughts. But thanks again for stopping by, my friends. Hope you enjoyed this quick update, and I will catch you in the next one. All right, take care, everybody. Bye-bye.